Hello everyone and welcome back. In this video we are going to talk about Meta Platforms because the company reported earnings and the stock is up 10% today. I'm a shareholder of Meta Platforms, it should be around 10% of my portfolio, so a core position. I've been a shareholder since 2018, so of course I'm monitoring what is happening within the company, if the fundamentals are good or not, and we'll go through the earnings report. We'll go through some slides and I want to show you some charts that will be pretty interesting to you. Also, I will tell you in this video if I'm buying more and if not, at what price I'm buying more. It can be pretty interesting here. In case this is your first video from this channel, welcome. My name is Christophe Noor. I've been investing in the stock market for almost a decade now and have achieved a performance of 25% per year. Thanks to Meta Platforms, by the way, because I first bought Meta Platforms in 2018 when the stock was hated and then the stock recovered. Guess what? During the Cambridge Analytica scandal, the stock was hated and the company recovered. And then you had many scandals, including 2022, the stock was hated and guess what? The company recovered. And now for the past few quarters, the stock has been a laggard to the global stock market. If you look at the Magnificent Seven companies, Meta Platforms is not in a great shape. It is not at an all-time high. The stock is a little bit hated and the business, I believe, will recover. So I made a video a couple of weeks ago, about the stock price drop and how it was unjustified. And I said it was a buy the dip opportunity and I expected great things in the future. And I also said that now we all know that Meta Platforms want to increase the Capex to run after AI and implement AI. And the only thing that matters for Meta Platforms is the revenue reacceleration. So for this quarter that we just had and for the remaining part of 2026 or the 4 quarters, the only thing that is important is how much Capex do you have, and 2, how much is it reaccelerating your revenue. So I can show you some charts. Here it is. You have your percentage change of revenue in orange here, and you have the Capex to operating cash flow. How much of your operating cash flows are you using to fund Capex? Well, you can see that recently the Capex has improved a lot. The Capex has increased a lot as a percentage of operating cash flow. I can show you another metric if you prefer. I can show you the growth rate of free cash flow, of Capex, sorry. It can be maybe more visual for you. Yeah, you have the same patterns. So in purple here, you have the growth rate of Capex. You can see that for the past quarter, the Capex doubled year on year. And now for the 4th quarter of 2025, the Capex is up plus 87%. They are investing massively, billions and billions of dollars to improve their platform, to improve their ecosystem with new data centers, new models, so they can implement AI everywhere. The goal here with this AI Capex is to 1, increase the time spent on Facebook, Instagram. 2, have a better system to deliver better ads with better targeting. Okay. And 3, having more ads. You can put a lot more ads in this platform. And thanks to AI, you can add a lot of efficiency to these ads. These 3 things will improve the revenue if done right. And what we're seeing right now with this orange line is, yes, because of the purple line, the Capex is growing immensely, but the revenue is improving. If you look at the most recent data, the revenue is up 20%. So yes, they are investing massively in Capex, but the revenue is going up 20%. Something you don't have for other Magnificent Seven companies. So if you can check the same chart, the chart we had before in blue here, the Capex as a percentage of operating cash flow. Let me leave it this way and I will comment on it later. Now let me talk about the report, because you had a few changes in this report, a few things that recently changed. By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. Okay, fair enough. Normally you can see, well, pretty good. So they are very happy with their performance. The revenue is up plus 24%. The costs are going up immensely. So the margins are down. The EBIT is flat. Now Meta Platforms is in a reinvestment phase of the cycle. Now the margins are dropping. It is normal and it was to be expected. The management team clearly told us investors, don't expect massive buybacks and dividends right now. We are focused on Capex and AI. We don't want to fall behind, so we are willing to overspend a little bit instead of missing the train. So gross margins are quite stable, but operating margins are down. And in the future, you can expect operating margins to go down again. 1 quarter ago, the theme was the same. The margins went down, the Capex went up, the revenue was up 20%, and people were worried. The stock price, Meta Platform stock price, went down 10%. Here, as you can see here, it was down 10% and then down and down and down and down again. Because people said, look at this, how margins are bad. We don't believe in the thesis. Mark Zuckerberg is crazy. And now we have the exact same quarter today. Margins are down, Capex is up, and now the stock is up 10%. This is why in this market you need conviction. Wall Street will sometimes give you opportunities to buy the dip. Nothing has changed. We are literally at the same price we had 2 quarters ago. The 2 quarters we had back to back are exactly the same. More growth, sustained growth, more Capex investments. By the way, speaking of Capex investments, the company increased their Capex guidance, right? You have more users, average price per ad is going up, you have more ads, exactly what I said at the beginning of the video. You want to track several things: the price per ad, the number of ads, and the time spent on every app like Instagram, Facebook. You have also more users, 7% year-on-year users. I mean, the report was fine, and the report is exactly a copy of the last one, which is great actually. They did a little bit of buybacks, and the tax rate is more reasonable right now. In the past quarter, you had a change when it comes to the tax rate. The taxes were extremely high, but it was to be expected and justified. Now the tax rate is back to normal. Anyway, because of the decrease in margins, yes, revenue is up 20%, but the earnings per share are only up by 11%. Yesterday, I released the video about MasterCard, how the earnings per share were growing 25%. Well, you don't have the same growth rate. I mean, if you want to compare different companies, yesterday it was MasterCard, today it's Meta Platforms. MasterCard is an asset-light business model with increasing margins, and they don't need any Capex to grow 20% per year. Meta Platforms, on the other hand, they are getting costlier and costlier. They need more Capex to grow, and the earnings per share growth rate right now is 11%. You now understand why in my portfolio I own more MasterCard than Meta Platforms. In terms of capital allocation decisions, I prefer to be invested in asset-light businesses. So now, how will you finance all your Capex? If your margins are going down, profitability is going down, how can you fund everything? Because if you look at the Capex of the company and the operating cash flows, you will see something strange. You will see that in the past, you could have covered all your Capex with your operating cash flows. But now the trend for Capex is skyrocketing, and maybe the business will need more debt to cover these expenses. Meta Platforms for the past 10 years was famous for being net cash, like Google. So you have a lot of profitability, you generate a lot of free cash flow, and you are net cash. For the first time in history, Meta platforms will need more debt. So they are raising some debt, and they have already started. If you look at the cash balance and the long-term debt, this is what you have. By the way, I'm using a website called Fiscal AI. I have a discount code in my description, so you can use it cheaper. It will get 15% cheaper for everyone who is using my link. You see that the blue line, the cash and cash equivalent line, was very high in the past, and you had no long-term debt. And then in 2022, the company raised some debt. As you can see here, in 2023, more debt. In 2024, more debt. And now in 2025, more debt. It will come a day where the company has more debt than cash. Maybe, I suppose, it will happen in 2026. It will happen, guys. They will use all their free cash flow, and they will use all their operating cash flows to fund Capex. They will need more debt, and they will raise more debt, which means at some point, if they have a lot of debt, you will have interest to pay. So that's an additional cost to the net profits. And I've seen no one talk about this. We will see. An ongoing challenge for 2026. Anyway, they are hiring 6% more people. Business as usual. And now here is the big important part. The CFO outlook commentary. We expect the revenue to be in this range. We expect the cost to be immense. And we expect the Capex spend to be immense. Look at this line. We expect 2026 capital expenditures to be in the range of $110 billion to $130 billion. You can see what was this line before. What was the Capex in the past? You can go to cash flow statement. You scroll down, you go to Capex, and this is what you have last 12 months. On a last 12 months basis, this is what you have for the Capex. An already high Capex of $70 billion. And the management is telling you that this line will go from $70 billion to $120 billion. Like almost doubling your Capex needs. Do you really think the revenue will double in 1 year? I don't think so. So margins will go down. So the free cash flow margin will go down immensely. Actually, maybe the company will not produce any free cash flow. If you look at the operating cash flows of the business, and if you look at the Capex of the business, you can actually calculate the free cash flow. Free cash flow is orange line minus the blue line. This is what you have. Your free cash flow is this. As the company is investing massively in more Capex, the free cash flow will go down. I wouldn't be surprised if, for some reasons, in 2026, the company doesn't produce any free cash flow. And actually, the company will have to take more debt to finance all their Capex. And this is why I said the earnings report was good, but I'm not a fan of their strategy actually. They need to grow immensely their Capex to survive. So far, it is working. If you look at the slides, they will tell you the same thing. More users, more ads, it is working. We are talking about an extremely profitable business model. The ads segment is very, very profitable with fat margins. They are having a low tax rate and Capex is high, Capex is increasing, you have more users, nothing really challenging here. The ad impressions are improving for all the regions. This is what I said at the beginning of the video. You want to use AI to, one, add more ads on the feed of everybody. You want more ads, more volume, and at the same time, you want more pricing. As you can see worldwide, the price per ad is going up. What is really great to see is that for all the regions of the world, they have delivered more ads in more volume. So literally, they are ramping up monetization on Instagram and Facebook, by the way. Also, it was recently announced that they are ramping up monetization for Threads, their equivalent of Twitter, but called Threads. And they have what, 400 million users, from mobile. So yes, you will have more ads. I am expecting these lines to continue to go up in the future. More impressions, more pricing. So actually for 2026, I expect the business to grow revenue at 20% per year. They can continue to grow at this rapid pace, so they can justify their high Capex. Now, I will not buy more Facebook because the Capex strategy worries me. They are now forced to invest in more Capex. They have shown the world that it works, but I want my portfolio to be filled with companies that are doing buybacks where the margins are improving. Yesterday, I uploaded a video about MasterCard. This is a prime example of this. 2 days ago, I uploaded a video about MSCI, prime example of this. We are talking about companies that are implementing AI without a lot of Capex, just implementing AI everywhere to boost margins, and they use all the majority of their free cash flow to do buybacks. Meta Platforms is not in this situation. So I already have 10% of my portfolio allocated to Meta Platforms. I am not selling Meta Platforms, but I'm not buying more Meta. I would just enjoy the flow and continue holding because it is a quality business and one of the top 5 CEOs of the world, in my opinion. So you don't bet against Mark Zuckerberg. Every time he's doubted, he has shown many times in the past that he's very nimble, very flexible, and almost all the time he wins. So you don't want to bet against Mr. Zuckerberg. It's quite stupid to bet against Meta Platforms. So I will just hold my position in case the business deteriorates and the stock drops below $600. Then I will revisit because the stock will be quite cheap. Now, if you look at the valuation, Meta Platforms must have a PE ratio at 2025 for a business growing 20% per year. The valuation right now is reasonable, one of the cheapest stocks out of the Magnificent Seven, but I want my portfolios to be filled with companies that have huge free cash flow margin. And I'm afraid for 2026, 2027, Meta Platforms will not produce any free cash flow. Margins will go down and they will not reward shareholders with buybacks. So I like this report. It was a good update. I will monitor what is happening, but I'm not buying more. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn the strategy I use to outperform the market. You will learn how to find winning opportunities. You will learn how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, inside the program, you will have access to an exclusive community of like-minded investors, and you will also have access to my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a short video that explains how everything works, completely for free. No need for your email address, just click the first link in the description and I'll see you on the other side.